Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here again at AusBiz as we get across what happened overnight. Global equity markets gaining to begin the week amid concessions and confusion over US tariffs. Mega cap tech shares drove Wall Street higher after the Trump administration removed smartphones and other electronics from its tariffs on China. Technical analysts noting, though, that the S&P 500 is now in a death cross pattern where the 50-day moving average slips below the 200-day moving average, where a shorter-term correction could turn into a longer-term downtrend. Apple shares rose as much as 7% earlier in the session in response to smartphone exclusions from those reciprocal tariffs, with Apple relying on imports from China. Nvidia announced it would begin manufacturing AI chips in the US. And Dell Technologies and HP also climbed, with concessions extending to those other electronic items, and President Trump also suggesting he may grant exemptions on car makers as well. The shares of copper miners tracked the price of the red metal higher, with US listed shares of Rio and BHP benefiting. And drug maker Pfizer saying it would end the development of its experimental weight loss pill. Well, the tax on US imports now comes to around 20%, according to BlackRock, which it says has undermined business and consumer confidence, saying in a note to clients that prolonged uncertainty raises the risk of recession. It may drag on corporate investment and delay long-term commitments. Well, Goldman Sachs Chief Executive David Solomon has said we're entering the second quarter with a markedly different operating environment than earlier this year. Well, the New York Fed's inflation expectations survey for 1 year ahead has risen to 3.58%, well ahead of the prior reading of 3.13%. Meanwhile, FOMC member Christopher Waller has called the new tariff policy one of the biggest shocks to affect the US economy in many decades. The future of that policy, as well as its possible effects, is still highly uncertain. This makes the outlook also highly uncertain, demands that policymakers remain flexible in considering the wide range of outcomes. Well, the US 2-year Treasury yield has fallen to 3.82%, the 10-year down to 4.36%, markets pricing in just a 15% chance the Fed funds rate will be cut by 25 basis points at the next meeting on May 8th, with 3 cuts in total by the end of the year. The US dollar index down around 0.4% on the day, the Aussie trading at 63.2 US cents, and Bitcoin is trading at around 84,500 US dollars. Well, oil prices settled slightly higher on Monday on tariff exemptions and data showing a sharp rebound in China's crude imports in March. Brent crude futures at $64 a barrel. Copper continuing its recent rally to be up almost 3.5%. Iron ore rising 0.5% to $99 a tonne. And gold dipping as risk sentiment improved, retreating from a record high of $3,245 an ounce. Okay, let's get straight to Wall Street. What we're seeing there more broadly, obviously, for the latest pronouncements from Donald Trump. And Steve Sosnick joining us from Interactive Brokers. Steve. So,
great to see you.
What did you make of that last session? There was intense focus, clearly, on companies like Apple, given these exemptions, if you like. But as I mentioned earlier, there's still a lot of confusion, isn't there?
So much confusion. Part of it is, did we just suddenly notice that Apple makes, cell phones and things of that nature, and that was going to raise their costs dramatically? I guess each event that we back off, where we back off from tariffs is generally good news. It's certainly good news for Apple, because we don't want, one of the largest companies in the index to be, kneecapped by tariffs. But these things are getting worn away, but the problem is no one really knows how to plan for it. I was talking to someone who had a meeting with a bunch of manufacturers out in Colorado, and he was saying that they don't know what to do, because the tariffs seem to be off for now, but what happens in 90 days? Or what happens if someone changes their mind? And so there's so much uncertainty moving around right now. Each individual move away from tariffs is generally a good thing, but the specifics make it very, very difficult still for companies to plan. And we'll start to hear that as earnings season rolls out in greater form over the next couple of weeks.
Touch on that. I know you always have a go at the fact that banks lead off for earnings season. What did you make of what we've heard? Obviously, given we're in such an interesting environment, and clearly it's all about what's to come.
I discount the things like Goldman Sachs having a better, or some of the other firms having better trading revenues. That's one of those things that doesn't carry over. What does carry over are the comments, where you have someone like Jamie Dimon saying that we're seeing more turbulence. You referred to the comments from David Solomon at Goldman Sachs. That's what I like to listen to in these earnings reports, not whether bank A or B had, made a little bit more money trading commodities, or whether they reduced their duration or increased their duration over the course. We're not hearing about a lot of, pain from consumers or major businesses, but we are hearing a lot of uncertainty. Uncertainty brings volatility, which is what we've certainly experienced, in spades. And I think until or unless this gets resolved, we're going to continue to hear something of that nature from the various companies. But I want to hear it more from industrial companies. This week we start to get some pharmaceutical companies. I want to hear from sort of the more the type of businesses that need a longer runway to plan their business, rather than a bank, or a bank with a large trading operation that can move it around relatively quickly.
Steve, just 2 weeks ago, the US was regarded as a global safe haven for investors. Now, I know you've written about this too. It's not just tourists that are maybe shunning the United States. Are investors shunning? And perhaps is that potentially going to lead to a liquidity issue?
It could. I mean, the Treasury Secretary Bessent tried to downplay those. He did an interview, I believe, with Bloomberg after the close today, where he tried to say he didn't think it was foreigners selling, but the evidence seems to be the opposite. We have what we saw over this past, really the last couple of days. It have reversed a bit today, but Wednesday through Friday, we saw very aggressive selling in bond markets, where yields rose very sharply, while at the same time the dollar lost a lot of ground against key trading partner currencies, specifically the euro and the yen. But dollar fell about 3 to 4% last week. The dollar didn't recover much today, although the bond market did ahead of those comments. But that to me is a sign that foreigners are exiting the market, and that's really not good for U.S. markets. I saw a statistic that I think at the end of 2024, they estimate that foreign investors own $17.5 trillion worth of U.S. stocks. And it's important to keep in mind that partially because we have a very large trade deficit with so many countries, I'll argue our largest export is government debt. And so, foreign investors, are buying a lot of that government debt, in some ways, recycling the trade surpluses that they have with us. And so if we start to see, the tide ebb from U.S. assets, that's a problem, because it certainly lifted the equity markets over the last couple of years. And obviously the bond market, the mechanics are a little bit different. And I think kind of what spooked markets on Wednesday was just ahead of the 10-year auction, we saw the Chinese yuan hit record lows. And so I think that got people nervous. What if they don't buy? And what if they don't buy in the auction? What if there's Chinese selling, or they don't buy? And I think that caused people to freak out. Then the auctions for the 10 and the 30-year notes actually went pretty well, but that didn't stem the selling that we saw on Friday, and the continued weakness in the dollar. If you have higher rates, you're supposed to see a higher currency. And that's really not the case unless it means money's flowing out. You could argue that it's good for equities. A weaker dollar is certainly good for the multinationals that export, to the extent that people want to buy our stuff right now. But remember, most of these big cap companies do business around the world, so that helps their currency translation a little bit. So there's a little bit of an argument to be made for why stocks did okay, but it seemed to me that that money was clearly flowing out of bonds. It's not necessarily freak out levels, but it definitely had a tone to it. And also another clue is it stopped at exactly 11 o'clock Eastern time, which coincidentally is 5 o'clock Central, most 5 o'clock in most of Europe. And, no coincidence, they were going home for the weekend at that point. And the selling literally stopped.
Steve, has the damage been done? Is that confidence, business, consumer confidence, been undermined to such an extent that this is a fast-moving train now? What's it going to take to reverse that?
That's a great question. I think just calming things down I mean, right now, the sentiment numbers that you alluded to, they're awful. The University of Michigan numbers are among the worst we've seen in years. And one-year inflation expectations have zoomed. Usually those follow the price of gasoline at the pump pretty closely, but that really hasn't that really hasn't budged very much. As a matter of fact, it actually went down a little bit. We saw in PPI and CPI, but it doesn't matter. People are starting to get very nervous. They're seeing government cuts on a lot of programs, and this cuts. Pardon me. This cuts across political stripes. Certainly, Democrats view the Trump administration in a negative light. The independents started to follow, and now we're actually starting to see Republicans starting to come to follow a little bit as well. So it's I don't know what makes people confident again. I think you just need some relative calm for a while, but it's unlikely that that's going to occur. Bearing in mind, of course, that besides the tariff back and forth, we're going to have to negotiate a debt ceiling again and budgetary stuff. I've heard as early as May we could run out of money, but I believe it's actually more like June or July. But they've got to get off their stick, and if they're not raising money from tariffs to the extent they were, and the government cuts are not as deep as they thought they were. Elon Musk admitted to 150 billion. The goal was somewhere between 1.5 and 2 trillion. So 150 is kind of a drop in the bucket. Are they going to cut taxes and blow up the budget even more? It's understandable why, if I were an international investor, I'd be saying maybe I don't want to have quite so much money there. But in terms of the U.S. Economy, I think just people are getting whipsawed by the back and forth and sort of the day-to-day difficulty that we have in handling the news flow.
For joining us from Interactive Brokers. Steve Sosnick there out of Connecticut in the States. Let's come back home, take a look at where we're likely to get going, and another positive start. SPI futures up around 0.25%. That follows the hefty gains we saw yesterday on the local market. Stay with us. We'll get it right across the open in just a couple of minutes' time.